In this video, we're going to now take all the information we learned about this journal entry worksheet and how to do journal entries, and we're going to do journal entries, okay? All right, so the first thing is here we have ABC Company received, again, we're always doing journal entries from the perspective of the company. ABC Company received $50,000 cash in exchange for common stock. So the first thing we want to know, right? The first step is what's being exchanged. The company is giving cash, the company receives cash, so they're getting cash in exchange for common stock. So common stock is being given, cash is being received. So what are the accounts? The accounts are cash and the accounts are common stock, okay? So what's happening to those accounts? Well, receiving cash, so cash is going up. And the other thing is, whenever a company issues common stock, people get confused about that. That also means common stock is going up. So we've got two things going up here. Cash is going up because we're receiving cash. Common stock is going up because we're receiving common stock, right? So now we need to know the account types. Well, cash belongs to assets. Common stock belongs to common stock, right? So we identify the accounts. We identify the account types. Now, what's the next step? Well, what's happening to those accounts? Well, cash is going up, so cash is an asset. So we're going to debit cash, and common stock is also going up. So what do we do to common stock? We credit common stock because common stock is part of the common stock section when it's going up. So in this case, we had two things going up, cash going up, common stock going up. We debited cash because it's an asset and it's going up. We credited common stock because it's common stock and going up. Remember, whenever a company receives money in exchange for common stock is going up. So our journal entry would look like this: debit cash for 50,000, credit common stock for 50,000. Okay? Let's look at the next one. You purchased office supplies on account. Whenever you see this phrase on account means that you bought it on credit. Okay? And here's an account, which is accounts payable. Accounts payable is used whenever a company receives something or buys something and they don't pay for it, they buy it on credit, we use accounts payable. Sometimes we use notes payable, but we'll deal with that later, okay? So the company purchased office supplies on account for $300. So again, what's being exchanged here? The company is receiving office supplies and the company is giving an IOU, that's what credit is. On account means I'm going to owe you $300, and we talked about that. That's accounts payable. So you received office supplies, that's going to be the supplies account. And if you see office supplies or supplies, it's the same thing. Some people use office supplies, some people just use supplies. It's fine. So you're going to have the supplies account, and then you're going to have accounts payable. Okay, so those are the two accounts. Now, what's happening to these accounts? If the company purchased office supplies, then supplies is doing what? Going up or down? It's going up. So supplies are increasing. And what happens to accounts payable? What's happening to accounts payable? Well, after this transaction, does the company owe more money or less money? The company owes more money. So accounts payable is also going up. So we have two things going up here. Supplies going up and accounts payable going up. So now let's match these to the account types. So supplies, we know, is an asset account. That's going up. And then accounts payable is a liability account, and that's going up. So what do we see happening, right? So if supplies is going up, what are we going to do to supplies? It's an asset, so it's increasing, so it's going to be a debit. Accounts payable is a liability, and it's going up. So what are we going to do? It's a credit, so we credit accounts payable. And so our journal entry is going to be a debit to supplies and a credit to accounts payable. Okay? That's how you do journal entries. So as we go through these, when I pull up the entry, stop, see if you can figure it out, and then watch the answer, right? You've got to practice these. That's the only way you're going to get good at it. Okay, so you purchased furniture on account. When you see on account here, that means on credit, so you know that's accounts payable. And what did you purchase? You purchased furniture. So what's the exchange here? We're receiving furniture and we're giving an IOU, right? We're receiving furniture and we're giving an IOU. So what are the accounts? Well, is there an account related to furniture here? Well, if I look, I see furniture and fixtures. So if you use furniture or furniture and fixtures, it's fine. Some companies will just have furniture. Some will have furniture and fixtures. So we have a furniture and fixtures account. So that's my account here for furniture and fixtures. And on account, we know that's accounts payable. So now, what's happening to these accounts? Are they increasing or decreasing? Well, furniture is going up because we're receiving furniture. So now we have more furniture than we had before. And then accounts payable is also going up because when we purchase something on account, we owe that money, right? So If you're ever stuck on accounts payable, just think, do we owe more now after this transaction or less? In this case, we owe more after this transaction. So since we owe more after this transaction, accounts payable is going up. So furniture is going up and accounts payable is going up. So once you've done that, once you've figured out the exchange, you figured out the accounts, you figured out whether the account is going up or down, now you just need to map them to the account types and then figure out the debits and credits. Well, furniture and fixtures we know is part of the asset account, which is and furniture and fixtures is going up. So we're going to debit furniture and fixtures because it's an asset and it's going up. Accounts payable is a liability account and it's also going up. So we know we're going to credit accounts payable because whenever it's a liability and we increase it, it's going to be a credit. So our piece here is going to be debit furniture and fixtures for $350, credit accounts payable for $350. Okay. So now here we have paid $90,000, and that means when you paid $90,000, that means we paid that in cash to acquire land. So what's the exchange here? The company's receiving land and the company's giving cash, right? So do we have accounts? Yeah, cash, we know the cash account. What about land? There we go. There's a land account. So those are our two accounts, land and cash. So now what's happening? We're receiving land. So does that mean land is going up or down? Land has to go up because we're receiving land. What about cash? Cash is going down because we're paying $90,000, right? So land is going up, cash is going down. Okay, let's map it to the account types. So cash is an asset. When it's going up, what do? We debit cash, right? We paid cash. Sorry, cash is going down. Land is going up. I apologize. So land is an asset, right? What do we do to land when it's going up? When it's increasing since it's an asset, we debit land. And cash is going down. Cash is an asset. So what do we do to the asset? When it's going down, we credit cash. Okay, so in this case, we're going to debit land because land is going up, and we're going to credit cash. So here's the thing. Here's a shortcut. Now that we've done 4 entries, you'll notice something. Whenever cash is involved, right? When you receive cash, that's a debit to cash. When you pay cash, that's a credit to cash. So one of the shortcuts you can do is whenever you have a journal entry, look for the cash part of the journal entry first. If the cash part, if you're receiving cash, you're going to debit cash, and that means whatever the other account is going to be a credit, right? So you see up here, well, this is accounts payable. This is accounts payable. This is cash. See how we debited cash here? So if you debit cash, that means whatever the other account is has to be a credit, because remember, we have to have one debit and one credit. And look at line 4, right? Here we credited cash, so whatever the other account is has to be a debit. So one shortcut to doing journal entries is first look for cash. If it's just 2 accounts in the journal entry, if you're going to debit cash, that means the other account has to be a credit. If you're going to credit cash, meaning you paid cash, then the other account has to be a debit. So that's a shortcut. All right. So it says you perform services. Now here's a new account that we've never seen before. You perform services and received a promise to pay the $1,000 in 2 weeks. So here's what's happening. This you really got to think about. You went out and you did work for a customer, and the customer didn't pay you. They promised to pay you within 2 weeks, right? So perform services and received a promise to pay the $1,000 in 2 weeks. So you went out and did work for a customer, and the customer is going to pay you later. Okay, so now how are we going to recognize those accounts? So if we go over here, when you do work, I'm just going to tell you that's going to be service revenue. Okay, so whenever you see perform services, that's going to be service revenue account. So when we did work, what did we receive? We received a promise to pay. Now, when we owe someone money, when we give someone a promise, when we promise to pay someone, that's an accounts payable because we owe them money. When a customer gives you a promise, when a customer promises to pay you, there's an account called accounts receivable. That's what accounts receivable is. So accounts receivable is when you receive a promise from a customer to receive payment. So you're going to debit accounts receivable, you're going to have accounts receivable, and you're going to have service revenue. I'm getting ahead of myself, right? So service revenue and accounts receivable. So this gets a little bit tricky, at least the first time you do it. So whenever you perform services, that's the service revenue account, right? And here, the service revenue account is increasing. So whenever you see perform services, that means the service revenue account is going up because the service revenue account tracks the total amount of services performed. So service revenue is going up. And what about accounts receivable? Well, Accounts receivable is going up also because you're going to receive money, right? If after this transaction, someone owes you more money, that means the accounts receivable is going up. So we've got accounts receivable, which is an asset, which is going up. So accounts receivable is an asset, it's going up, we're going to debit, right? And then we have service revenue, right? It's going up also. Revenue is a credit when we want to increase. So we're going to debit accounts receivable and credit, not unearned revenue. We're going to credit service revenue. I'll fix that. Unearned revenue we'll talk about later. Okay? So this entry, you'll see entries like this all the time. When you perform services, this is a revenue entry on credit, right? So you perform services, you're going to credit service revenue, you're going to debit accounts receivable. Okay, here we go, another one. So this was services performed on credit, but this entry is services performed and receive cash. So you perform services. Whenever you see the phrase perform services, think service revenue right away. Service revenue, not only service revenue, but service revenue increasing. So we perform services and we receive cash. So this one is actually a little bit easier. We know perform services is service revenue going up, but we receive cash, that means cash is going up, right? So both of those is going up. We gave services, they gave us cash, both are going up. So we look to the cash account. When cash is going up, what do we do to the cash account? Since it's an asset, we debit it. Service revenue is going up, right? What do we do to the revenue account when it's going up? We credit it. So we have here debit cash, credit service revenue. So 5 and 6, these are some entries you want to keep in mind. Whenever you perform services on credit, your entry is going to be debit accounts receivable, credit service revenue. Whenever you perform services on cash, you're going to debit cash and credit service revenue. In both cases, you're crediting service revenue because you did work. All right, let's look at the next one. Now, paid for office supplies purchased on account. You purchased the supplies for $300. All right, refer to transaction 5. Now, this is important. Let's go back to transaction 5. So here's what, not transaction 5 actually, transaction 2. Okay, so you purchased office supplies on account for $300. So on this date, what happened is you bought office supplies, you received the supplies, and now you owe whoever gave you the supplies, you owe them money. Okay, so on this date, let's say it was the 2nd, you bought supplies and you owe whoever gave you the supplies money. Let's say Office Depot, you owe them money. Now, what are you doing here? Okay, let me change this to transaction 2. What you're doing here is now you're paying for the supply. So here's the big mistake people make in this transaction. They say, oh, we paid for office supplies, and they assume that you are getting more office supplies. No, you're not getting more office supplies. You already got the office supplies. If you look at transaction 2, transaction 2 says you purchase office supplies on account. So you already received the office supplies and you issued an IOU. All you're doing is in transaction 7 is you're just paying for the office supplies you already received. So you are not receiving more office supplies, you're just paying for the office supplies you already received. Okay, so we can use the shortcut here. If you're paying, what are you going to use to pay? You're going to use cash, right? So the cash account, we know cash. When cash is going down, it's a credit because we're paying. When cash is going up or we receive cash, it's a debit. So we know we are going to credit cash for $300. Why? Because we're paying for office supplies. Well, what is going down, right? If we pay something, what has to go down? Well, in this case, whenever you're paying something off, remember, if you look at transaction 2, what went up? Accounts payable, right? We debited supplies and we credited accounts payable because we owed whoever it was $300 in cash. So whenever you owe money, you put it in accounts payable. So what do you think is going to happen to accounts payable when we pay the accounts payable? Well, when you pay the accounts payable, or when you pay off this balance, the accounts payable goes down. So let's look at accounts payable. Accounts payable is going down, right? Accounts payable is a liability. What do we do to a liability when it's decreasing? You debit it. Okay, so we're going to go down in transaction and we're going to debit accounts payable. And I want you to look at transaction 2 and transaction 7 because those are 2 steps that occurs very often in accounting. One is you buy an item on credit. So you debit supplies, you credit accounts payable. It could be any item. It could be furniture. It could be a building. It could be whatever it is. You buy it on credit. You debit the account for the item you received, and then you credit accounts payable. And then now when you pay for that item, right, instead of crediting accounts payable, what do? You debit accounts payable to get rid of the accounts payable, and then you credit cash. So now we go to transaction 7, And what do you see happens here? We debit accounts payable, right? Because the accounts payable goes down, and we paid cash, and you credit cash. Okay? All right, let's look at 8. You received $1,000 in cash on account. Okay, now we refer to transaction 5. Okay, so here is sort of the other side of that. In transaction 5, you did work for a customer. And the customer said, hey, I can't pay you today. I'm going to pay you in 2 weeks. Okay? So you already did the work. You debited accounts receivable. You have this accounts receivable here, which represents money that's owed to you, and you credited service revenue. The mistake that people make when they read this, they say, okay, received $1,000 in cash on account. And I wrote it this way because the problems are going to usually have it written this way. But what this is saying is you received $1,000 for the outstanding accounts receivable that you have. So if you received $1,000 in cash, right? Let's do that part first. Cash is an asset. You received an asset, you receive cash, you're going to debit cash for $1,000. Okay, so that's the first part. All right, so what are you going to credit? Well, what has to come down? Well, if you look at transaction 5, what do you have is you have this outstanding accounts receivable here. Your accounts receivable went up. This represents money that's owed to you by the customer. So the customer is now going to pay you this accounts receivable. So what's going to happen to the accounts receivable? The accounts receivable has to come down. So you go to credit accounts receivable to bring it down, right? Accounts receivable is an asset. When we decrease an asset, what do? We credit it, okay? So you received $1,000 in cash on account. What this means is, whenever you see this, this just means that you received money for an outstanding accounts receivable. It's not worded the best way. Okay, 9. You paid, again, whenever you see paid, when you pay cash, when you pay someone in cash, that's cash is going down. When you receive cash, cash is going up. So we'll use the shortcut. You paid employee salaries of $10,000. Right away, we know that's cash. What's happening to cash? It's going down, so we're going to credit cash. So we put credit to cash. And you'll notice that I always put the debit first and the credit second. Usually that's a good way to do it. Okay, so now we paid employee salaries of $10,000. So what this means is our employees worked for us, and now we want to pay them salaries. Okay, so whenever your employee does work, whenever somebody does work for the company, that is an expense. Okay, so do we have an expense account that is related to salaries? Yes, it's salaries and wages expense. So whenever your employees do work for a company, we adjust this salaries and wages expense account and we debit it. So salaries and wages expense, this is where, salaries expense or salaries and wages expense. This is where some people get confused because they think, okay, well, salaries and wages expenses, it's going up. How could the expense be going up? Expense accounts tracks activity. So when I look at the expense account and I see $5,000 in there, that means this company incurred $5,000 worth of wages. That means the employee did work for the company that's worth $5,000. So every time the employees work, you increase the expense account, right? So we have other expenses here, like insurance expense. Every time the company uses insurance, you increase the insurance expense. So expense accounts, as activity goes into those accounts, they actually increase. All right, so paid rent expense $500. So you should immediately know what to do with this. If you paid something, right, that's cash. What's happening to cash? Cash is going down because we paid it, so we're going to credit cash, right? So that makes that very simple. If we're going to credit cash, whatever the other account is has to be a debit because there's only 2 accounts here, and that's going to be rent expense. So we debit rent expense, okay? So that's the trick. Look at cash, do the cash part first, then go back and do the other accounts. If it's more than 1 account, then that becomes a little bit more difficult. But if it's more than 2 accounts, it becomes difficult. But if it's just 2, do the cash part first and go back and do the other one. So again, rent expense. Whenever a company uses up rent, right, or uses up a space, they debit rent expense. Okay, here's another one. Paid cash. What do? You should know, right? When we paid cash, cash is an asset. It's going down. We're going to credit cash. So whatever the other account is, doesn't matter it is, whatever that other account is has to be a debit, and we're going to debit dividends. And I'll talk about dividends in a second. Dividends, in most cases except one, you will debit dividends. Whenever you pay out dividends, you debit dividends for the amount and you credit cash. So if you look at the dividends account, right, the dividends account is increasing, so we debit it. Why is the dividends account increasing when we're paying dividends? A lot of people don't understand that. They think if you're paying dividends, the dividends should go down, right? Dividends, again, is like expense. The dividends is a tracking account. So every time a company pays dividends, they put it into the dividends account because that tells the company, okay, this is the amount of dividends that we actually paid. So the dividend account tracks the amount of dividends that has been paid, or that have been promised. Let me say that when we get to dividends account, you'll see that later. And same thing, expense. The amount of expenses that have been incurred, that's what we put in the expense account. Okay, let's look at number 12. All right, you paid, again, you see this with cash, right? You paid $1,200. So again, that's going to be cash. Cash is doing what? If you paid it, cash is going down. It's a credit to cash. So I'm going to credit cash for this amount. Now, this is a new account. You paid $1,200 in cash for a 12-month insurance policy. So what you're doing is you're paying $1,200 in cash for 12 months worth of insurance. So this $1,200 is going to cover the next 12 months. So you're not going to use up all of this insurance right now. You're going to use it up a little piece at a time for over 12 months. So really what's happening here is you're prepaying for insurance, or you're paying for insurance ahead of time. And there's a very special account that we have to track that, and that is called prepaid insurance. So you'll see that, and that's an asset. So whenever you pay insurance ahead of time, there's prepaid insurance. You'll also see something here called prepaid rent. When you pay for rent ahead of time, it's the same thing. So this is a prepaid insurance. It's an asset account, and whenever you pay for insurance ahead of time, that increases the asset account or prepaid account. So you're going to debit prepaid insurance. Okay? And even if you didn't know that, even if you knew the account but you weren't sure about the debit or credit, you could have looked at the cash first, then go back and do the other one. Okay? Now here we come to our first compound entry. Our first compound entry, which means that there is more than 2 lines. You'll see down here, it's 3 lines. So for these, what you need to do is split it up and just do 1 line at a time, okay? So what's happening here? The company purchased office supplies for $400, and then they purchased furniture for $1,000, and both of these were on account, meaning they didn't pay anything. They owed money. So let's do the first part, the part that we know. Well, office supplies, right? What's happening to office supplies? If we purchase office supplies is going up. And then furniture, what's happening to furniture? If we purchase furniture, furniture is going up. So if I look down here, we have supplies is an asset, that's going up, so I'm going to debit it. Then we also have furniture is an asset, that's going up, I'm going to debit it. So my 2 debits will be for furniture and office supplies, or supplies, right? The furniture is going to be 1,000, the supplies is going to be 400. Well, in a journal entry, you can't have 2 debits. If you have debits, you have to have a credit. And remember the rule: if the credit amount must be equal to the total of the debits amounts. So now we receive supplies and furniture. What did we give? We gave an IOU, right? What account do we use for IOUs? It's accounts payable. So what's happening to accounts payable in this case? Well, we are now owing $400 and we're owing $1,000. So we owe now $1,400 for both of these things. So both of these things were done on account. So since accounts payable is going up, we're going to credit accounts payable for both, or the $1,400. All right? Okay. Let's go down. So now here we have another one. Take a look at this and see if you can do this on your own. Pause the video, see if you can figure this one out. Okay, so let's do it. Let's break it up, okay? You bought a building for $10,000. Let's stop right there. You purchased the building. So what's going to happen to the building? What's going to happen? What account is that? Well, we actually have an account that's called buildings, right? So buildings is an asset. What's happening to the asset? It's going up because you purchased a building for $10,000. So we're going to debit building for $10,000. How do you know it's a debit? Well, buildings is an asset. It's going up. So I debit buildings for $10,000. Okay? Now, what did I give in exchange for this building? Now, this you've got to be careful, right? I gave $5,000 in cash. Okay? So let's stop there. I gave $5,000 in cash. So what's happening to the cash account? Well, my cash account is going down because I paid cash, right? How much cash did I pay? $5,000 in cash. So I'm going to credit cash for $5,000. Okay, but this entry is out of balance. We have a debit for 10 and only a credit for 5, so we're missing another 5,000. Where's the other 5,000? Well, I paid 5,000 in cash and I gave an IOU. What account is an IOU? It's accounts payable, and it has to be a credit because we've got to have $10,000 on the credit side, right? So this is going to be credit accounts payable for 5,000. So even if you didn't know to go here and say accounts payable is going up, I'm going to credit it. You could back into this answer because you know I've got to have $10,000 on the credit side because I have $10,000 on the debit side. Okay. All right, last one. Well, actually, there's going to be one more I'll do just really quickly so to introduce you to this account. So you paid March rent for 2,000, right? So here is a really good one. So you paid March rent for 2,000, you paid employee salaries for 3,000, and March utilities for 500. So these are all things that you paid at the end of March. So we know when we pay these things, right? Since we paid 2,000 and 3,000 and 500, all of these are being paid, and we're going to assume if you paid it with cash. All of these are being paid with cash, so we know we can credit cash here for the sum of all of that. Okay, 2, 3, and 5. And it'll probably be easier to do this first part first, right? Or if you can't figure that out, then just do the parts you know. You paid March rent, right? Whenever you pay rent like that, that is going to be rent expense. So we have an expense account. The expense account tracks activity, so it's tracking the amount of rent that you incurred, so that's going to be a debit to rent expense, right? This is employee salaries. This is the employees that worked in March. So what account is that? It's going to be salaries and wages expense for these employees. And so you're going to do salaries and wages expense, which is $3,000. And then you have utilities, right? Utilities, light, gas, etc. So do we have a utilities expense account? Yes, utilities expense. So we're going to have utilities expense for $500, okay? So on the debit side, we've got 3 to 5,500. How did we received all of this. What did we give in exchange for that? We gave cash, right? So cash is going down for $5,500. Okay, I'm going to add one more example here because I think it's worth noting. So let's say ABC Company received $500 from a customer and will perform the work next month. Okay, now this is an interesting. You should immediately be able to figure out the first part of that, right? Because what did you receive from the customer? You received $500 from the customer, right? So if you receive $500 from the customer, what is that? That's cash. Okay, what's happening to the cash is going up, so we're going to debit cash for $500. Okay, now here is the tricky part. And this is what tricks people up because people say, okay, well, I received $500 and they want to credit service revenue. Because remember, here we have service revenue. That's when you do work. So you would credit service revenue whenever you do work. But did we do work? No, we did not. It says we received $500 from a customer and will perform the work or the services, right, next month. So we haven't done anything. The customer gave us money and we haven't done a thing. We're going to do it next week. Or next month. So what do we record right now? Well, there's a special account for this, and it's in the liability section. It's called unearned revenue. Okay, unearned revenue. So what you would do is you would have unearned revenue 500. And you could actually, I'm going to explain why we're crediting unearned revenue, but we know if we're debiting cash, whatever the other account is has to be a credit, right? So this is a debit to cash. We know that this one has to be a credit to unearned revenue. Okay. Now, why is it a credit to unearned revenue? Well, unearned revenue is a liability. Okay. Liabilities represent what we owe. In accounts payable and notes payable, usually that means we owe money. Well, in unearned revenue, right, we don't owe money here. What do we owe? We owe work or services. So the customer paid us ahead of time, and now we have to go out and perform the work. So unearned revenue is whenever you do work whenever you get paid before doing work. So you owe your customer work, so that's why it's a liability. It's a liability because you owe them $500 worth of services. Okay? So these are great examples of journal entries, and I just wanted to go through this just to give you an example. So what I would recommend is going through this video again, or I'm going to post this handout on D2L and see if you can do these without looking at the answer. You've got to practice journal entries. The more you practice, the better you'll become.